Hey everyone, and welcome back to the channel. Today, we're re-diving into a topic that trips up so many people who are just starting their investment journey. Stock market myths. Have you ever heard someone say the stock market is just like gambling, or that you need a ton of money to even think about investing? Well, we're about to bust those myths and a whole lot more. Sticking around for the next few minutes could completely change how you see the market and help you make smarter, more confident financial decisions. Let's get right into it. Let's tackle the big one first. The stock market is basically a casino. This is probably the most common misconception out there, and it's easy to see why. The short-term ups and downs can feel random, like a roll of the dice. But here's the fundamental difference. When you gamble, the odds are statistically stacked against you over the long run. The house always wins. When you invest in a stock, you're buying a small piece of a real operating business. You're not betting on a random outcome. You're becoming a part owner of a company that produces goods, offers services, and aims to generate profits. While a company can fail, your investment is based on its potential for growth and success, not on pure chance. Think of it this way: a gambler hopes to get lucky, while an investor uses research and analysis to back businesses they believe will succeed over time. Historical data shows that over long periods, the market as a whole has consistently trended upwards, rewarding patient investors, which is the complete opposite of a casino's business model. Another huge myth is the idea that you need to be rich to invest. This might have been true decades ago, but today, it's completely false. Thanks to technology, the barriers to entry have crumbled. With the rise of commission-free trading apps and the availability of fractional shares, you can literally start investing with as little as $5 or $10. Fractional shares are a game changer. They allow you to buy a small slice of a high-priced stock like Amazon or Google without needing to afford a full share. You can own 0.01 shares of a company if you want. This democratization of finance means that anyone, regardless of their income level, can start building a portfolio and putting their money to work. The key isn't how much you start with, but the habit of consistent investing. Small, regular contributions can grow into a significant amount over time, thanks to the power of compound interest. So, if you've been sitting on the sidelines thinking you don't have enough, I'm here to tell you that's no longer a valid excuse. You can start today with whatever you can afford. Now, let's talk about timing. "You have to time the market to make money" is a phrase that leads many new investors astray. People get obsessed with trying to buy low and sell high, waiting for the perfect moment to jump in or cash out. Here's the hard truth. It's nearly impossible to consistently time the market, even for the most seasoned professionals with supercomputers at their disposal. The market can be irrational in the short term, driven by news, sentiment, and a million other factors. Trying to predict these swings often leads to buying high out of FOMO, fear of missing out, and selling low in a panic. The data is clear on this. Studies have shown that investors who simply stay invested in a strategy called time in the market tend to perform much better than those who try to time the market. Missing just a few of the market's best days can drastically reduce your overall returns. Instead of being a market timer, focus on being a long-term investor. Adopt a strategy like dollar cost averaging, where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. This approach takes emotion out of the equation and ensures you buying more shares when prices are low and fewer when they re-high. This next myth is often perpetuated by flashy social media posts. Investing is a get-rich-quick scheme. You see stories of people making a fortune overnight on a hot stock, and it's tempting to think that's what investing is all about. But that's not investing. That's speculation, and it's incredibly risky. For every one person who gets lucky, there are thousands who lose their money chasing these volatile trends. True, sustainable wealth building through the stock market is a marathon, not a sprint. It's about patience, discipline, and the magical effect of compounding. When you earn returns on your investment, those returns then start earning their own returns. Over years and decades, this snowball effect can turn a modest portfolio into a substantial nest egg. Legendary investors like Warren Buffett didn't get rich overnight. They got rich by investing in solid companies and holding them for the long term, letting their wealth compound year after year. So, resist the urge to chase quick profits. Focus on building a diversified portfolio of quality investments and give it time to grow. That's the real secret to success. Here's a scary one. The stock market is rigged against the little guy. It's true that large institutional investors have advantages, like access to more resources and sophisticated tools. However, the market isn't a zero-sum game, where for them to win, you have to lose. The overall economy grows over time, creating value for everyone involved. Plus, individual investors have some unique advantages of their own. We don't have to worry about short-term performance pressures from clients. We can afford to be patient and hold our investments through market volatility, waiting for their true value to be realized. We aren't forced to sell during a downturn to meet redemption requests. Furthermore, regulations are in place to protect individual investors from fraud and manipulation. Information is also more accessible than ever before. With the internet, we have access to company reports, financial news, and analysis that was once only available to Wall Street insiders. By investing in low-cost, diversified index funds, you can essentially own a piece of the entire market and grow your wealth as the economy grows, completely bypassing the stock-picking game and leveling the playing field. Finally, let's debunk the myth that what goes up must come down. People often apply this logic to stocks that have performed well, thinking a crash is inevitable. While corrections and bear markets are a natural part of the economic cycle, a good company's stock price isn't just governed by gravity. A stock price goes up because the underlying business is growing, increasing its earnings, and becoming more valuable. As long as the company continues to innovate, expand its market, and improve its financials, its stock price can continue to trend upwards over the long term, even with short-term pullbacks. Look at the long-term charts of successful companies like Apple or Microsoft. They are filled with dips and corrections, but the overall trajectory has been powerfully upward for decades. The key is to focus on the company's fundamental health, not just its recent price action. If the business is sound, a dip can actually be a buying opportunity, not a reason to panic. So, let's quickly recap what we've learned today. The stock market is not a casino. It's a vehicle for owning pieces of real businesses. You don't need to be rich to start. You can begin with just a few dollars. Trying to time the market is a fool's errand. It's time in the market that builds wealth. Investing is a long-term strategy for building wealth, not a get-rich-quick scheme. And finally, while the system has its complexities, it's not inherently rigged against you. As a small investor, you have unique advantages. By understanding these truths and letting go of the myths, you strip away the fear and anxiety that hold so many people back. Knowledge is your greatest tool. It allows you to approach investing with a clear, logical mindset, focused on your long-term goals. Don't let misconceptions dictate your financial future. Thank you so much for watching. I hope this cleared up some common misunderstandings about the stock market. If you found this video helpful, please give it a thumbs up and do not forget to subscribe and hit that notification bell so you won't miss our future content. Drop a comment below with any other stock market myths you've heard. See you in the next video.